Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network.
Before we get into today's show, there are a few things we have to go over.
Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you'd get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program. Welcome to the show, Tom and Will. It's great to have you on.
Thanks for having us. Yeah, thank you.
This is the first recording we've done with three people with a video format, so we've had a few technical mishaps, mostly on my end. But I'm hoping the guys can listen to this, and the guys and girls that listen to this, they can watch it also on our YouTube channel, so feel free to go over and have a look at that. But guys, what I thought we'd do is, with this longer form conversation, is I'd like to understand a bit more about who you are, but because there's three of us, or particularly two of you, what we might do is we might take it one at a time. And because you know each other so well, feel free to jump in and kind of explain any sort of situations or stories, or recall any good memories that you have of each other, or just that you might have passed along to one another over the years. But why don't we start off with you, Tom? I think people will be familiar with you with your time at BKI, but maybe you can just tell us a bit more about you, where you grew up. And I'm really looking for that kind of that genesis story, how you come to be an investor. But maybe instead of going all the way up to your time now, why don't we just go to your childhood, early childhood, and leading up to university?
Yeah, sure. As we said before, thank you very much for having us on the show. I grew up in Cowra, which is in the central west New South Wales, on a cattle property, which was purchased by my grandfather in the 1950s. It was a very good upbringing. It taught you how to work hard. We had a cattle property, so the whole circle of life thing was sort of born on us pretty early. You learn how to ride a motorbike and drive a car at an early age, and a tractor and all that sort of thing. So it was a really good upbringing. We didn't have any sort of big flashy holidays as kids either. So we'd spend a lot of time fishing and shooting and water skiing and camping and all that sort of thing. So it was a really, really good upbringing. I suppose finance and business and that sort of thing on a farm, you don't really become aware of that element. You work hard, but you just work because that's what you do. And we weren't ever paid pocket money or anything like that for doing chores. You just sort of got it done and did it. I think the first memory of actually doing anything for any sort of money was the Comalco cash for can incentive in the early 80s. My grandfather and dad were very involved in the Cowra Rugby Club, and big days versus Forbes and Grenfell and Parks. All the parents used to probably drink a fair bit in the early 80s, and there's a lot of cans lying around. So as a kid, I used to go around with Hessian bags and grab them and take them into the local guy. And then I sort of stumbled across the fact that you put a teaspoon of sand in each of them, made them weigh a little bit more. You earn a bit more money. So I was telling Will that story before, and I think he hopes that I'm a bit more ethical than that now, which is probably right. But I think as a 10-year-old kid, I thought it was genius.
Hopefully no one's listening to this. They can call you up.
So that was my first real, I suppose, chance of earning any pocket money. You'd go and buy a tennis racket or a footy or something like that, and that was the first thing. But as a business sort of sense, I think it was more sitting around the Christmas table, Millner families talking about the pharmacy and how pharmaceuticals were going and what investment Sols were looking at and that sort of thing. I didn't understand a lot of it as a kid, but I always found it pretty intriguing. So that was sort of the element of getting into the finance part down the track. But there was never really anything pushed on us by doing business or reading economic books or anything like that.
How about you, Will? I think many people will be familiar with the Millner story, but chances are many will also be familiar with your story. I know there was a write-up in the AFR recently about you from Tom Richardson, one of my old colleagues. Perhaps you can give us your backstory, where you grew up, and I guess anything that you took away from your parents and their business, and I guess even grandparents.
Yeah, no, sure. Thanks, Aaron. So I'm a Sydney born and bred. Grew up in Lane Cove, and you know, like Tom, had a very happy childhood. I have one sister. We're still very close. My father had a furniture manufacturing business that my grandfather had started. So Pop was a US war veteran. He was a coder during the war, and then met Gran during one of his furloughs, and then they fell in love, and he built a life in Australia. So he and a few mates set up a business called Everett Worthington, which was in St. Peters originally, and then they got their big break when TV came in, and they made big, massive furniture cabinets, kind of 6 to 8 foot long, and that was the start of his success story. And Dad joined that business, which had then evolved to more bedroom furniture and home entertainment furniture and things like that too. And that was out at Revesby, and you know, that was the family business. And Mum was at home and looked after Amy and I, and you know, we had a really good life and spent a lot of time together. And then, so in terms of the stock market, it wasn't really, you know, a big part of our family at all. I think it was all about the furniture business and, you know, the property that underpinned that. And in the Christmas holidays, from probably 12 years old, we'd go out and work on the packing line and in the furniture in the factory, and that was, you know, it was hard work, but it was good, and you know, it taught my sister and I the value of education and the value of working hard, but also, you know, the importance of working with other people and having a good culture. And Dad and Pop would walk the floor and talk to everyone, and it was good, but it was it's a tough industry, manufacturing, and it's become tougher. And in my teenage years, it was changing a lot already, and it's changed a lot more now. I wasn't looking at that closely back then, but as I worked there more, you know, going into university, it wasn't really my passion. I spoke to Dad and Pop about that, and being the only son and the third generation, it was a discussion I was a little bit nervous about, to be honest. But they were very, you know, they wanted me to do where my passion lay, and eventually I studied finance at uni and came down this path. But it was you know, similar to what Tom said. You know, we were fortunate to have really happy childhoods and good families, and you know, be close to having that. You know, the farm was one family business, the furniture is another family business. But you know, from a young age,
How about? Well, I'm particularly interested in knowing how, I guess, that experience working in the family business shaped you, and then I guess if there's any opportunity for you to reflect on that now and kind of how it adapted you to, I guess, old markets and how we think about businesses today. I mean, you mentioned there that manufacturing is pretty tough these days, right? But I know that you guys have somewhat industrial focus, and you have businesses that pay dividend yields and all these things that we can typically associate with industrial style companies. Is there anything there that, and I'm going to ruin the surprise here, but maybe it's not much of a surprise, but you're both Charlie and Warren Buffett fans, and there's a few other names we'll get to throughout the conversation, but you know, he's the famous saying is better businessman because he's a better investor. So I'm wondering how that rubbed off on you there, Will, and then maybe we'll jump across to Tom.
Yeah, so just on that manufacturing side, I think it teaches you a lot about cycles early on as well, and not just from an economic perspective, but things like fads as well. And so as that business developed, it went from, as I said, TV to then bedroom suites. You'd go to Grace Brothers and David Jones back in the old days, and you buy the whole bed, cabinets, cupboards, the works, to then evolve actually into more entertainment furniture and computer desks, and then flat pack furniture. And you know, Harvey Norman and Freedom were big, important customers when I was working there in the early 90s, and you know, that too, fads changed. So if you consider now, you know, the busiest part of the year was just after Christmas. Everyone had gone and bought a TV or a new computer, and they needed a stand or a desk to put it on. And now every TV is on the wall, and everyone's got a laptop on their kitchen bench. So you kind of, the two key products just don't exist anymore. So I think from that perspective, I think it's you know, you realise the importance of fads and cycles, but then manufacturing as well is just we've lost competitiveness in Australia, and then as imports increased, things like IKEA came in and made it really difficult. So it's a very capital-intensive business. Which, talking about Munger and Buffer, they increasingly talk about capital-light businesses are becoming more and more valuable. But it was a good upbringing of just seeing how the business cycle worked, and then also we had the advantage, I suppose, as well, that in that late 80s was a boom, early 90s was a pretty difficult period, and we're kind of old enough to have seen that last kind of recession in Australia too, which was when you're home in the family business, it has a pretty impact on you.
For sure it would. How about you, Tom? I noticed that after school, correct me if I'm wrong here, you went and got a Bachelor of Industrial Design. Is that correct?
Yep, that's right.
How did that conversation go? Obviously, being investors at home, saying, I'm going to go study this Bachelor of Industrial Design, and then I guess I'm interested in the turning point back towards investing as well.
Yeah, sure. It was quite easy, Owen. We, a bit like Will and his family, we were always encouraged to do what we loved and what we were good at and what our passion was. And mine was being creative, and I like working with metal and welding, and I suppose that's a bit of a farming influence as well. As a kid, if you broke something, you had to quickly fix it, so you learned how to weld very quickly. And so, I developed a passion for, I suppose, design and creative arts, and then I got into sculpture. So I went to Newcastle Uni, did industrial design, which was a really great practical course. And I sculpted for quite a few years, and did a bit of travelling, and then went back to the family farm for a couple of years. And then I suppose the point where it all sort of began to interweave itself was I entered the Sculptures by the Sea in Bondi with a mate from Cowra, and we made these crabs, and we made 15 really big crabs out of old farm parts, and we did well. We won a couple of awards and won the People's Choice Award, and that was wonderful, but it was really hard work, and trying to find the next exhibition, and then you work out that the commission, they take 30 or 40% off you, and it was really tough. And then so at the same time as that, I'd been sort of working in the family businesses as well, and Dad approached me after I'd sort of spent 2 years back in Cowra and said, look, we're looking for a junior analyst role in one of our investment companies. This was in early 2002, January, just after September 11. The things weren't great, but I thought, right, I'll come to Sydney, I'll have a go, and I just actually really enjoyed it. And that was the sort of first real time I'd sunk my teeth into investing properly. But I really, really enjoyed it. And so after the Sculptures by the Sea was finished, I thought, right, I'm done with that. I've enjoyed it. I could always come back to it if I want to have it as a hobby. And then, we sort of, Priscilla and I started a family at the same time, and it sort of all went from there.
So were you two, and I'm jumping ahead of myself here, but were you two friends growing up? Did you know each other?
Yeah, we did. And our families knew each other. Our dads knew each other from their school days, but we weren't. Every summer holidays we might catch up for a family barbecue and maybe see each other once a year on the sporting field or something. But it was
right.
Pretty good acquaintances, the two families.
Yeah. So how about that next step for you, Will? I know you spent a bit of time overseas. You did your Bachelor of Business. Maybe you can talk us up to the point that you joined BKI, and maybe even why you went across to BKI in the first place.
Yeah, sure. So, as you said, I did a Bachelor of Business and was really fortunate that I had a job at Salmat during that time. We had family friends with Phil Soldier and Peter Maddock, and they built successful catalogues and laser printing business at the time, and I worked there during uni, and that was really valuable. I learned a lot from those two, and something that Tom and I reflect on a bit is that there's a lot of mates and business that doesn't work. And Pete and Phil were two guys who were schoolmates, and they'd set up a business together in the late 70s, and they were, for mine, a really great success story of mates and businesses that did work. And we actually spent a bit of time with Pete when Tom and I first started working together, and kind of said, well, what are the rules? And one of the key things he said to us was, you're going to make a lot of decisions together, but the rule is you can never say to each other, I told you so. Once you make a decision, you're in it together. And it's been a really valuable lesson for us. But then he looked at us both and said, what are you worried about? You're going to have a lot of fun too. And we have. So it's been nice. And it's good to work with someone who's a good mate, but someone you trust and trying to build something together as well. So Sal, Matt and Pete and Phil were very valuable for me as well. So then my first role was, I then after uni, I got a job with Challenger in the early days. They were selling endowment warrants then. And then after a couple of years there, I went over to the UK for 2 years on a working holiday visa and had a lot of fun. And then I came back, and probably similar time to Tom, it was 2002. It was the economy was probably a little bit fragile, and I got a job with Concord Capital, which was a small fund manager, a boutique fund manager. They'd spun out of MLC, employee owned, and growing quite quickly as industry super funds became more prevalent, and they were looking for active managers. And I started in the back office, and then got a lot of support from the directors of that business. They put me through a Masters of Commerce, and kind of just gradually had to turn doing the dealing, and then did some equities analysis, and then was there for 11 years and ended up being a portfolio manager there. So it was great. It was a very good business. But then that business got acquired by Invesco in the US, and through kind of no fault of Invesco, I kind of changed the model a bit, where it had gone from employee owned to not, and a lot of clients didn't like that. And it was the big lesson for me there was that we had 10 to 12 big clients, $5 or $6 billion, and some of them then didn't like the change in ownership, and they pulled their money, and all of a sudden you walk in and you're dealing with a $700 million outflow, and you own 25 stocks, and then the stocks get smashed, and the next client comes along and they say, well, your performance is gone, we're out too, and you get in this death spiral. And you know, the beauty of BKI and that listed investment company, Permanent Capital Investing, is the opposite to that. So you don't have to worry about a big mandate being pulled, and you can really invest for the long term. So I learned a lot during those 11 years, and I was very grateful for that. But I think this model of having some permanent capital too, enables you to take longer term decisions.
Absolutely. We'll get to the idea behind permanent capital in just a moment, but maybe I'll throw it over to you then, Tom. Did you, when you were at BKI, did you call up Will and say, hey, what do you think about this? I know you guys were at BKI for a few years, and we'll give you, all the listeners, an overview of the family of brands, but how did you guys come to work together?
Well, let me just finish quickly on that story, because what happened was then we lost so much money that Invesco closed the business.
Okay.
The Sydney office at least. And so I was then out of a job. And Tom and I become kind of reacquainted by that point, met through the markets. And I actually asked Tom if I could just come and help him out a day or two a week and have a base in the city.
Oh, right.
So I looked for another job. And that was great. That helped. That was good for both of us.
I put him to work immediately, Owen.
Yeah. When was this?
So this was early 2013.
Yeah. Right. Okay.
So BKI was quite established then. We'd listed in 2003, and we'd grown from 170 million to about 400 million. And then in about 2013, we did another equity raising and raised 150 million, I think, from memory, which sort of took us over that threshold of, I suppose, importance, liquidity, scale from the LIC point of view. We're always trying to keep up with the Miltons, the Aficionados of the world, which have been around for decades and really well run and established businesses, and have got great scale, and anywhere between sort of 30 and 90,000 shareholders each. So this capital raising put us into that sort of next band where we were all of a sudden managing $700 million. And then so once Will was in the city, in the office working with us for a while, we worked really well together. We'd already, as Will said, become good mates again. We trusted each other. We were bouncing ideas off each other. And as we grew, it sort of went from me being the CEO and sole employee to needing to find a portfolio manager or a senior investment analyst. So it was very easy when we did the search basically yell over the room and say, "Would you mind if I put your name forward to the BKI board?" And
Yeah.
happy to work together. And that was 2013, and it's gone pretty well since.
For those listeners who maybe aren't familiar with the BKI business, and maybe a bit of background on Sol Pattinson as well, maybe Tom, I'll throw it to you before we get into the contact story, just to explain kind of like the family of brands and how they all fall together today.
Sure. Well, let's just stick with BKI just while we're on that theme, and it sort of it'll hopefully highlight the strategy that we've had at Sols over a long period of time. Sols and Brickworks created cross shareholdership in the 60s. It was one way of Sols diversifying out of pharmaceuticals into other industries and investments, and Brickworks was basically the first of those investments. And then my great uncle Jim Millner and Dad started to then acquire, shares, listed shares, Commonwealth Bank shares, Westpac shares, BHP, etc., and built a reasonable portfolio. And then so did Brickworks, because Jim was also the chairman of Brickworks and Dad was on the board. So they kept these cash flow businesses reinvesting into equities, A, to capture franking credits, but B, also to hopefully grow and compound earnings over time. So both businesses set up some pretty good equity positions. And then Brickworks acquired Bristol Roof Tiles in 2003 and needed some capital. So rather than raise money, they went out and sold their equity portfolio and listed BKI. So that's how BKI was born, out of Brickworks. And so we grew it from there. And I think from that sort of strategy at that time, we'd also listed SP Telemedia out of Sol Patts. We'd just listed New Hope Group out of Sol Patts. So we'd sort of incubated these small companies for a long time and grew up with them. And then all of a sudden we'd sort of launched them and put them on the stock market and co-invested with other investors. And that's how BKI was born, was out of a business that was, I suppose, incubated within the group.
And I guess it comes back to that idea of permanent capital, permanent equity again, and the support that a big brother can lend to many of these smaller brands that, like you said, have been incubated so successfully. Will, maybe I'll throw it over to you now. Can you tell us, I guess, the genesis of the Contact brand and bring us up to today, the three strategies that you guys manage, your day-to-day, and just kind of how it all sits together in your average day, I guess.
Yeah, sure. So the Contact story itself, as you can kind of see behind us now, we have a few horse racing pictures. And a couple of years after Tom and I started working together, Tom's great aunt moved out of her family home, and Tom found a few scrapbooks and brought in these old leather scrapbooks, and he knew that my great grandfather had been a horse trainer and trained a Melbourne Cup winner and back in the 40s. And Tom said, I found these old books. And he said, what was your great grandfather's name? And I said, it was Danny Lewis. He said, you're kidding me. And he said, look at this. And we opened the scrapbook, and there's all these clippings of Tom's great grandfather, Max Cleverin, and my great grandfather, who owned horses together. And Danny Lewis trained them, and Max was an accountant, and they had a pretty successful partnership together. And the best horse they had was called Contact, and Contact won the 1936 Sydney Cup, and back in the day that was the autumn equivalent of the Melbourne Cup, and ran fourth, I think, in the Melbourne Cup. And it was a story that we talked about, that our fathers had known each other, and it was both their grandfather, and that story kind of been lost in the generation. So we've got a few of the clippings here and the finishing post photo in the office, and it's just a nice added history that kind of glues it all together, which is nice. So then after a couple of years at BKI, we thought it'd be good to kind of maybe try and do some other things as well, and we both had a bit more ambition than on top of running BKI, and we thought we could add some other products and strategies going forward. So at the end of 2016, we established Contact with the two of us, and we own 40% each, and Sol Patts owns 20%. And the first product we brought to market was Herb Investments, which has since been taken over. And we now, as you say, have three strategies. So the first one being BKI that Tom just spoke about. So BKI is a listed investment company with 18,000 shareholders. It's a market capitalisation of a touch over $1 billion. Big focus on long-term investing and income generation for our shareholders. And we're shareholders in this and all of the products that we're going to talk about. So a lot of the shareholders there are self-managed super funds, and the income is obviously very important. As Tom also mentioned, the second product is then the Soul Pat's large cap portfolio. So that is essentially the portfolio that sits on Soul's balance sheet. After that as well. That's a mandate that we manage, and that's got $300 million dollars in it.
That's the BKI equivalent that we were just talking about in the Brickworks portfolio.
Yeah.
And again, that's an important income generator for to help fund part of the Soul Pat's dividend as well, and part of their income. And then we've just developed a new fund, which is only a month old, which is Next 50 unit trust. That's the Contact Australia Next 50 fund that we've seeded with our money. And the strategy there is to buy high quality businesses that sit outside the top 50. Income's again a focus, and we'll talk about our process too. So the process flows over all three, but they're the three products we have in our suite at the moment. And then we're looking at formalising a kind of large cap product that's similar unit trust strategy to the X50 fund going forward as well. So over time we'll have four.
Yeah, right. It seems like, so from the outside, for people who are not familiar with the way investment management works and you win mandates, it seems like your day would be pretty busy overseeing three things. But I guess there's so much synergy between the funds, the strategy, the team, but also just in your process. So what you look at, the way you think about investing. You already mentioned that income is a focus, dividends is a focus, franking credits are a focus. Why don't I throw it over to Tom now? Tom, why don't you just give us a high level, what are you trying to do as you source this income? What are the pillars that you're working to each day when you have your daily meetings and those types of things?
We've got 5 pillars that we look at, and I think they've probably evolved out of the Souls group over many generations of looking at new investment opportunities. And you're right in what you say, the process is the same. It doesn't matter if you're looking at a building product business or a pharmaceutical business or a retailer or a resource company. The view is that the process is similar, it's robust, and it's repeatable. So we've got 5 pillars. The first one is principal activity. And basically under that banner is, what does the company do? How do they make money? Do we understand it? Because there's been a lot of investments by a lot of people over many years going into something they just don't understand, and it's burnt them. So that's the first thing, principal activity. Second one is income, and we've already talked about it a little bit, but as simple as it is, as simple as it sounds, a company paying a dividend, there's a lot that has gone on for that company to be able to have paid a dividend. It's got to be successful. It's got to have been around for a while. It's had to have made profits. It's had to be very successful. Most of the time it's paid tax and generated imputation or franking credits. So we get, a dividend or a franked dividend. So the ability of a company to pay a dividend for us is really quite important. The next one is the balance sheet and the strength of the balance sheet, because without a strong balance sheet, you can't pay dividends, and you go through cycles like we're in now, and every second company with a weak balance sheet's raising money, which dilutes shareholders, and it's not a great way to manage a long-term business, we don't think. So balance sheet strength's another key element. The fourth pillar is management. The people that run the business dedicate, that they're 5, 10, 15, 20 years of their life to this business, and they usually send that business down a path. And if they're a good manager, it'll be a good path. And if they're not a good manager, they tend to blow the thing up. So the good quality managers, and we'll talk about this probably a bit later, but the founders in most cases are managers of a lot of businesses that we own. We generally support as well. And the fifth pillar is valuation. And we might do all the work on a stock, but the valuation doesn't stack up. And we wait for moments like we're in at the moment, or another 12 years ago in the GFC where we're very active as well. of buying stocks that we've watched for many, many years, but just couldn't get our head around the valuation. We've done the work, but the cycle's in our favour, and we've been able to pull the trigger on the investment. So they're the main five, and we try and stick to that process always, right? As much as we can.
Yeah. Maybe we can loop back through them a bit, and maybe we'll start at the top with kind of the principal activity or competitive advantage of this business. I think if I could maybe loop this in with the income focus too, from the outside, what I see is that, and from the impression I get from you, is that the income is a result of the resilience of a business, and another word for that in the share market is quality and competitive advantage and those types of things. Will, maybe you can reflect on this. I read in one of the X50 fund documents that you had that you like to stress test a competitive advantage. So I mean, we know that we all do the same research. Some of us do the same research, but then there's some of us that can go further. Some of us that can think differently because they have permanent capital, because they can take their time with decisions, don't have to worry about so much the flows and that type of thing. I'm interested in your thoughts, Will, around how do you stress test competitive advantage? What are you looking for? Maybe you've got some counterpoints here or something like that.
That's a good question. It's really important. And and in addition to Tom and I, we have another 5 analysts as well. So we have a pretty robust team now. We have a checklist as well that we go through. There's 40 questions on the checklist, yeah. And it breaks these 5 points down into a few more questions as well. And the checklist is a good discipline in some ways of things we don't want to do, but it also encourages the team to make sure we've read the annual report, you understand the business, and pretty much get out there and walk the tiles, if you will. So a good example of what we did a few years ago on this and testing the competitive advantage was with Woolworths. And you may recall probably 5 years ago, Woolworths was a low $20 stock. It was under threat from Coles was growing reasonably well, but the bigger concern in the market was probably Aldi and Costco. And then people were looking offshore at companies like Tesco and some of the UK supermarkets on the margin decline that could come. And so we actually tested the theory of, well, is Woolworths a lot more expensive than others are saying, or will they lose? Will margins be at risk? And Tom and I actually jumped in his ute, and we went out and we did a basket of goods test at Aldi, Woolies, and Coles. And we bought a Vegemite toilet paper. We didn't forget toilet paper. Some milk, just some $50 to $60 of household goods, basically. And then we went to Costco as well. But what we found was that where Woolworths had that select, they had like a good, better, best strategy going on, and the select product was wrong, but they were actually the cheapest of the three. And the perception and the reality were actually two different things. And Aldi had a few tricks where the Vegemite was slightly smaller, and you didn't have quite as many rolls of toilet paper, for example. And when we looked into it and saw that what was actually the reality was that Woolworths sell a very competitive product, and we're doing up their stores, their online offering was improving. We knew that competitive advantage that had been there for so long wasn't dead, and we bought pretty aggressively. We then went to Costco, and we're walking around Costco, writing down prices, and the guy running the liquor section came up to us.
The biggest human being you've ever seen turned up and basically shirt fronted us and said, "What are you doing? We're writing all the prices down." I don't know which one of us said, "Oh, we're just trying to check and convince our wives that you should shop at Costco."
Two grown men.
Information, so we head out of there pretty quickly.
It sounds like a pretty unusual day, but it was a really insightful day, and it gave us the conviction that Woolworths is a company worth owning, and the competitive advantage is long lasting. And it's been a really successful investment for us since then. So, unfortunately, you can't do that with every business. You don't have the opportunity to walk into every business, but we look at things like return on invested capital as well as a competitive advantage. We think that above almost any other financial metric tells you so much about, is management doing a good job, as well as is the other returns sustainable and can they grow? And we often see that businesses that are having a declining return on capital, return on equity, often the share price follows. So that too, for us, is a pretty important determinant of competitive advantage also.
Absolutely. So, Tom, maybe when we step through the next one is the income focus. I think most people know the backstory with Sols or Soul Pats. Incredible dividend track record, decades. Is that where this comes from, or is this it's kind of a new thing to you? Have you done some study on this with regards to total returns or something like that?
Yeah, a bit of both, Owen. I think when you manage money, you've always got to be conscious of who you're managing money for and what their objective is and what you've told them you're going to do. And I think when we started BKI in 2003, it was a traditional LIC with sort of capital preservation and the view of increasing our dividend over time. So that was very important right from the start at BKI, and I think also at Sols. The Washington 8 Sol Pattinson shareholder was a co-owner of the stock with the family, and we all like dividends, and we'd been successful, so we were happy to share that with everyone. And I think from that you then, I suppose, become educated on that actual investment, that yes, this company has proven itself over a long time. Its product or its service that it offers is a good one. It's been around a long time. It survives cycles. It can share those rewards with shareholders. But I think the other thing to always keep an eye on is that they're not paying out too much, because once you get to 80, 90, 100% of an operating business being paid out in dividends, there's obviously not enough left to go back into the business and reinvest for future growth. So good dividends, high dividends are wonderful, but you don't want to be too greedy, because you've always got to put a bit back in the till and invest in a refresh program or an acquisition to enhance growth or something like that to keep up with the changing times of that business. So there's a few more dynamics than just putting your hand out and receiving a fully franked dividend.
How do you monitor that insofar as is this like a return on capital thing, or how do you keep tabs on whether the business is allocating the capital effectively, whether it be to shareholders, buybacks, or what have you?
Yeah, it's a bit of a blend. I think every company is different. Every company may see the opportunity to have a buyback, or they might have a growth program or a refurb program or an exploration program or whatever it is. So I think it's a stock specific element there, but it's something they've always got to be doing something for the future, because you just get left behind otherwise. If Woolworths and Coles, even in this environment, hadn't spent a lot of money, billions of dollars over the years, having the best food offering, service offering, online offering, being able to source products off millions of producers, they wouldn't be doing what they're doing today, even in this environment. So it's very important that we do keep an eye on that, and it's sort of different metrics per stock.
Yeah, it is. We just want to be very conscious of. It depends a little bit, I think, as well, where the business is in its life cycle. If a business is growing quite rapidly and there's wonderful reinvestment opportunities, well, you'd hope the payout ratio is a little bit lower. And certainly some of these companies we're looking at in the X50 space, the payout ratios are 30, 40%, but the returns are in the 20s. So that to us makes sense. But one of the things we look at in terms of back testing is just the importance of dividends in the accumulation index, for example, where a lot of the media headlines talk about the index is at 5,000, 6,000, 7,000 points, and we're not back to pre-GFC levels. But if you look at the All Odds Accumulation Index, where you're valuing the reinvestment of the dividends, well, the last 10 years up to the highs in February, the returns you're getting are actually very significant. So dividends are really important, and we think that sometimes goes underappreciated.
Yeah, and I think with BKI's, with the management cost in particular, I'm going to call out BKI here, even Soul Pats again, as co-owners, that income focus really plays a big part in that return, right? So one of the things that I noticed about BKI is, and correct me if I'm wrong, the 0.1% management fee, which seems to me to be incredibly low. So I guess, where did that come from?
When we externalised the management function out of BKI, when Will and I set up Contact Asset Management, we were very conscious of not being the fund managers that gouges the shareholder and charges the big management fee. So basically, what we worked on was our salaries or the cost of having a PM and a CEO, what that was equivalent to from a management fee point of view, and it was about 10 basis points. So what we offered shareholders in the agreement was a 10 basis point management fee, with the upside of, as we grew Contact, you'd then get access as a BKI shareholder to more and more resources and a bigger, broader team. So that's how it came about, and we're very proud of that. It's a very low fee. I find it very hard. I think, Willie, if we found anyone else in the market that would charge a fee as low as that for a closed-end traditional LIC, externally managed business. And again, we've harped on about this, but alignment. We own, as a board and management team, probably $55-60 million worth of BKI shares. So we were shareholders as well. We didn't want to get gouged. We wanted to focus on growth and dividends and not pay excessive management fees.
Yeah, great.
And indeed, with the new X50 fund, we've priced that well below the market. I mean, we do have a performance fee on that one, but the unique characteristic of that is that we have to outperform the benchmark, but we have to ensure that the return is positive. So we only win if the investor wins, and we just see some fund managers where they take a performance fee because they've outperformed an index, but they've lost money. They just didn't lose quite as much. And we don't think that's appropriate. And again, we think it's, we want to be aligned with the shareholders as well.
Yeah, great. How about when it comes to balance sheet? I know I read a slide deck from you guys that said that, you're looking at all the standard metrics, credit rating, multiples of debt repayments, those types of things. Is there anything in particular that you're looking at? We've seen changes to leases and those types of things being on balance sheet. Franking credits could be effectively an off-balance sheet asset. Are there any kind of tricks or tips you can offer us in that respect?
Well, I suppose those last few points you raised are really valid. You got to be pretty flexible with changing accounting standards and those sort of policies. So you got to be a bit flexible there. But I think a business has got to be able to serve its debt. A company may have 50% gearing, but it might also generate significant cash flows. So you've got to be careful that you don't just put a gearing parameter around investment opportunities. So I just think that what we've seen the last, say, month now and what we saw in the GFC, it was one simple thing that brought a lot of these businesses unstuck, and it was the balance sheet and the inability of those companies to be able to serve that debt. Doesn't matter how big it, even a company with gearing of 10%, if there's a big interest payment due and the doors are shut, then that business is in trouble, but it may only have a small gearing percentage.
I guess that comes back to your quality focus with regards to competitive advantage, and you're looking for businesses that can obviously pay dividends. So they're going to be businesses that probably have pretty sound margins, and you can bake in some assumptions there that kind of lend itself to that resilience piece that we talked about earlier. How about management? And I'll throw this over to both of you perhaps. One of my favorite things is actually talking to management and sometimes leading them down the garden path. And you can befriend them and you can kind of get things out of them that maybe they otherwise wouldn't if they weren't as comfortable. Are there any particular stories? And I guess, because I find that one of the best ways with management is counterpoints. Sometimes the best stories are the ones that went bad, but sometimes there are some really good stories there too. And I imagine you have quite a few. So maybe we can just take this one at a time. Just jump in. Feel free, guys. What you're looking for, maybe some stories or anything like that you have on hand.
I think to start with, what we're trying to do with these 5 pillars is intertwine the whole process. So I think management then ties back into balance sheet. So typically, if you've got a founder that owns a significant share in a business, the balance sheet's one thing that they keep an eye on, a really close eye on. If their name's on the door or their family name's still part of the business, that the balance sheet is manageable and under control. And then obviously the income part is under control as well. So that's probably the tie into the process. But we've picked some companies with great management teams. We're not too proud to say that we've picked some doozies as well.
We're very big on, if there's a change in management at the top level, it's a reason just to revisit the investment case as well. And as Tom said, we've got a couple of businesses where management come in and change, or they often then bring their cronies with them. A lot of yes men, and often it goes wrong. But for us, one of the biggest things in assessing management is, are they aligned with us? And Tom talked about founder-led businesses, and we've got a few of those in ARB, Magellan, Reese, Harvey Norman, all pretty good examples of those kind of businesses. But then we spend a bit of time with our guys looking at, well, what's the incentive structure, and is that appropriate? And you kind of find then that if these management teams are appropriately aligned, and it goes back to the Charlie Munger quote of, you show me the incentive, I'll show you the outcome. And we think that that's pretty powerful. Management teams we don't like is when a CEO gets up and says I a lot. We reckon that's not a bad red flag of how they're thinking about probably putting management first and shareholders second. Historically, that's been not a bad test. If you look at transcripts, a CEO who talks about I rather than we would probably, I imagine, underperform. It speaks a bit about the culture of the business also.
That'd be an interesting one if someone had some data handy, if they could run that across a transcript and see the outcome. I tend to agree with you. My intuition, my gut feel would say much the same.
You're into coding, Owen, all the analytics that you could run on big data on that now. You could probably do that work.
Yeah. Well, maybe it's a bit above my pay grade, but I'm sure one of the listeners probably will go out there and do it. But sorry, Will, I didn't mean to cut you off there.
No, I think they were the main points we wanted to make. But I think we really we try and invest in our products like our shareholders, and we like management teams that do the same thing.
And how about the last one? In terms of valuation, is this a deal breaker for you? I get the sense that because of the way that you've kind of crafted your investment process around that philosophy of a long-term focus, I get the sense that valuation maybe isn't the be-all and end-all for your process here.
Yeah, that's definitely true. I think with any sort of good or service, you get what you pay for a lot of the time. So, there's been a lot of businesses that are trade 5, 10, 15, 20% premium to the market always. And that's the sort of valuation you have to pay to own a good quality stock. It's probably the discount on that premium where we see some value emerging. And we're able to be very patient and wait for that. But yeah, there's no good paying 7 times PE multiple for a stock that's never going to trade at 10, 11, 12 times. It's always going to be 7 or less because you're simply just paying for a low quality business.
I find that there's just as much art as there is science in valuations, and you can, when we talked about, we have models in all our companies, but you can, as you know, you don't have to tweak a discount rate or a terminal growth rate too much to get a massively different answer. So a lot of the discussion we have with our team is, let's test the sensitivity to the valuation. If they, what happens around some of the margin assumptions or the revenue assumptions, and what does that do then to the base case? So we think we use that in the valuation more than trying to have a prescriptive, this thing's worth $1.22. We find that more useful. But we also find that if the other 4 pillars of the process are really strong, and we think then the valuation may not stack up, we wouldn't sell just because of that. And some of the lessons we've learned from many investors over the years is that often you make the money in the holding, and the high quality businesses will continue to probably surprise you to the upside. So if it's ticking the boxes across competitive advantage and principal activity, a good dividend that's sustainable, balance sheet's in good shape, and we have a capable and trustworthy management team, well, why would you sell it?
Just start again. You got to try and find something that's going to replace it with better attributes, which is hard.
It's definitely one of those things that I find that it tends to be a relationship between the more active managers and those returns falling away. One thing that we can talk about when we talk about discount rates is the cash rate, interest rates at the moment being very low. And I know you guys are fans of Messrs. Buffett and Munger, and you head over to Omaha every now and again. When it comes to the valuation piece, do you subscribe to their idea about Charlie's idea about cash coming from a business is just like cash comes from any other business, and therefore it should be discounted as such?
Yeah, a little bit. I think we're probably at the starting point a little bit more practical than that. We probably treat our cash position within our portfolios a little bit differently. People come to a fund manager typically, or should do, to invest in their product. So whether it's the Soul's Large Cap or BKI or Contact X50, generally speaking, you probably should be nearly fully invested, because that's what people are coming to you to have exposure to. They've got all the opportunity in the world to put cash aside and put stuff in fixed interest or term deposits or whatever it is. So the starting point of our cash positions in our portfolio is probably seen a little bit differently to sort of generally speaking terms of what's the discount on that cash. When in low rate environments, you're not going to get the income or the distribution or the interest payment that you would have typically got when rates were 5-6%. So it does vary the discount rate you put, or what the DCF outcome might be. But having said that, you might find a stock's better off valued at a sum of the parts, or a EV to EBITDA multiple, or something like that. So we're not beholden to just PE or DCF. We're trying to encourage our analysts to be as flexible as possible and try and find the true valuation that maybe the market hasn't quite discovered yet.
Yeah, it's a fantastic way to look at it. I've got to admit, whenever I try and do a valuation of Soul Pats, it's always the sum of the parts, because there's so many parts and it's growing pretty well. I just touched on there, I've heard before, Jared told me before we recorded the show that you guys are quite keen to get over to Omaha and go along to Woodstock for capitalists. I'm interested to know, because of the connections you would have made here in Australia, but also abroad, some of the investors that you two draw most of your wisdom from, maybe they write regularly, maybe they've written some books, you may not have met them personally, maybe you have. I know one story that you've come up with, and it's in some of the presentation material, but perhaps I'll leave it to you guys. Maybe Will, you can kick things off there.
Yeah, so the annual trip to Omaha is a great one that we've been fortunate to do. Like last week, I had to sit in our lounge rooms like everyone else and watch it on the webcast and watch Warren Buffett. But what we've done over the last few years is then try and combine that with trying to meet some other investors in the States. We actually catch up with a lot of Australian investors over there too, in America, and then we try and see some of the Australian companies that have US operations as well if we can. So we try and spend a week to 10 days over there, and it's a great trip and it's good fun. But over the last couple of years, some of the really useful meetings that I think we've had have been with Peter Kaufman. Peter Kaufman wrote Poor Charlie's Almanac. He's a very successful investor on his own. We had a great dinner with him many years ago and got a lot of wisdom out of that Tom and I often talk about. Tom Gaynor, who runs Markel, we had dinner with him one night as well. He's very much in this camp of finding high quality businesses that are appropriately levered, and again trying to align yourself with good people. So we're taking a lot of lessons out of that. He has a meeting also after the day after the Berkshire meeting. And then last year when we went, we met Chuck Akra. Chuck's got a fund that's based in a small town in Virginia, I think. Yep. And he's, that was kind of my takeaway from that trip was, and we touched on it already, but again about these quality businesses. And he said, the quality businesses continue to surprise you on the upside, and hold on to them and buy the good businesses. And those learnings, and that was just a cup of tea we had with him, and it was, it's really valuable for us.
I think the only other thing to add there is each time we've gone, there's been different environments of investing and economic activity. So I think the first year that we went, the Australian dollar was $1.10 US, which had never really been at before. And so we were trying to focus on what the US dollar as a currency meant. Was it still going to be, the world leading currency? And then we had the arrival of Amazon, and then they bought a big business, Precision Cast Parts, and they based that on a management team as opposed to buying a business a monkey could run because one day a monkey will run it, which is a huge change in thought from them. And then, right down to going to lectures at unis and seeing the business school of the university put on an exhibition of getting fund managers on stage and asking them questions and just entrenching you in wisdom. I think one of the other good meetings we had, Will, was Sam Zell in Chicago.
Sam Zell,
and Leo, his sister. It was just remarkable. You book a half-hour slot to see these guys, and 2.5 hours later, you sort of leave the office just buzzing, full of wisdom. It's great. So that's the one thing we missed this year, was not being able to travel and get some insights out of these guys.
And that's the thing, Owen. Like a lot of it is just it's wisdom, and it's not rocket science. I walk out of the Berkshire Hathaway meeting each year, particularly you get from Charlie Munger, is he's just so rational and sensible and tries to have the emotion out of play. And there's not any high finance going on or advanced mathematics. It's just good long-term sensible thinking.
One of the things that you brought up, Tom Gaynor from Mark Elcourt, and of course Berkshire Hathaway with the similar insurance style business and that float that they can invest. And then we look, here across back to Australia, and a lot of people think that I guess the sole way of investing is the Australian version of that. This permanent capital. And one thing I want to ask both of you about is, how do you think that has enabled you to invest better than another fund manager may be able to?
We're a bit different to a private equity business or a big fundy relying on an insto mandate that Will spoke about before. You just don't know when they're going to call that capital back from you. So I think the beauty of having closed-end capital is you can look as far out as you want, whether it be 5 years, 10 years, 15 years, 20, 50 years, whatever it is. You don't have an end in sight. Maybe you're putting something together to have an event, and you're having an acquisition strategy. That's a little bit different. But generally speaking, if you've got that ability to back a mature business and run it and improve it and run it through the cycle, that's wonderful. But if you've all of a sudden then got the ability to, with one of your next investments, go into the incubation stage, buy 20, 30% of it, put a couple of directors on the board, and help direct that business into the future and give it a bit of financial strength and longevity, then you create a TPG, or you create a New Hope, or you create a Brickworks. And I think that's been the beauty and the secret ingredient of Souls, is we've just looked so far out because we've got this closed structure of capital, and all we're doing is we're being custodians of that capital. We're not trying to run it and be the next best portfolio manager and have one generation portfolio management business. We're trying to create businesses that are going to be here forever. And you don't get that if you've got an open-ended product.
Yeah, I see it quite a bit. You mentioned, Will, that one of the things that Charlie Munger's known for, and of course he is just this ability to think rationally almost all the time. Like, there's always a rational answer for almost everything. And probably the most common way I see fund managers fall down is when they know that they have to act rationally, but they can't because of some mandate or because of some preconceived idea that they have to window dress on the last day of every month or something like this. Because like you said, you fall into that death spiral and it's constantly looming over your shoulder. It's waiting there for you. If you fall 10% behind, you get myopic investors. Even in your business with the X50 fund and Contact, you've got so much of your own personal money behind it. I get the impression that the both of you can just think with a bit more clarity, because you don't, yes, you care for your investors, absolutely, but you don't have that pressure, the constant nagging over your shoulder.
You're spot on as far as we're concerned. So in terms of developing these new open-ended products, I think we're coming at it a bit differently to everyone else. So we have the permanent capital there first in a sustainable business. And we're now just looking at new products where we can grow and offer just different solutions to people who want to invest alongside us. But in terms of we just don't get caught up in that month-to-month treadmill. And we've had days where we've run into other fundies and you're saying, how you going? And they say, oh, we're having a good month. Yeah, mate, it's the 8th. It's just a way of investing that we just don't think that way. And, and maybe that's part of the Soul Patch DNA that's just come through to us. And our business has been listed since 1903, never failed to pay a dividend and really thinks long term. I think we're just trying to do that with Contact and the products that we're investing in as well.
As we come to the back end, guys, there are 2 more questions. One would be, you've obviously got the X50 fund. How can anyone find out more about the 2 of you, get in contact with Contact or anything like that?
Just on our website, contactam.com.au is the simplest way. We sort of try and fly under the radar a little bit as individuals. You won't read too much on us, but all the facts and figures are in the PDS or annual reports on our website.
Great. I think I might have skipped over one, and I'll provide all the links in the show notes, but I think I might have skipped over one question. It's that the daily meetings that you have, can you explain to us what they are and who's there and how it takes place?
Yeah, sure. So as I said, we have a team of 8. There's Tom and I, and then Tom's father, Rob, comes to the meetings when he can, which is most days. Charlie, our dealer, runs it and gives us a traditional morning meeting in that's what happened in the markets yesterday, what's happened overnight, interesting research, interesting articles, and then we go around the room. Where we're a little bit unique is that all our analysts are generalists in that we don't have sector-specific analysts. We think it's more valuable. Tom and I are analysts as well as portfolio managers, but we think it creates a more robust discussion, and it doesn't force people into a narrow thinking where they might just be the bank's analyst and they're only concerned about the CBA better than ANZ, rather than think about the whole portfolio and the opportunities in the market. And then indeed, when we're talking about CBA versus ANZ, there's wider discussion. So yeah, that goes on in the meetings too. So each morning we do that, and that's a bit of a news flow. Each week we then will go through a stock or 2 in more detail of this checklist that I discussed before. And that's where we get the model on the screen. The analyst presents, and that's a point where we kind of encourage a few challenges, respectful disagreement. We think the disagreement is good, but and then we also then bring it back to this whole speak up if you don't agree, because our rule together of I told you so permeates through the rest of the business as well. So it's a good team effort. But the morning meeting goes for 15-20 minutes generally, and then we're all here. But at the moment we're doing that through Microsoft Teams in this new world we're in, and that's working pretty well also.
But the team are also aligned. They all own stock in the products we manage. So the alignment filters right the way through to our analysts in our business as well, which we think is really important.
That's an interesting one, Tom. Just quickly, when you think about that alignment, does the team get rewarded with longer term options or incentive structures? I've heard of some managers paying out options that vest over 3 years equally or 5 years or something like that to try and drive home that long term incentive structure.
Yeah, we do. We have an LTI, 12-month LTI, which is a bonus that we encourage our analysts to buy stock. BKI and now the X50 funds open, units into that fund, and they're more than willing to do that and have done that. So that alignment again from a longer term bonus point of view is really important, and it just changes the dynamic when you're in a meeting. With a morning meeting that Will just talked about, you're pitching on an idea that is a good idea, and you want to invest in it because you own units or shares in the products that we manage. So it sort of just completes the circle and changes the psyche a little bit.
For sure. Okay, fellas, last question. Maybe we'll start with you. If you could go back and tell yourself one thing about money, finance, or investing, mate, what would it be?
I think you got to start early. I think, and one of the great powers of investing is compounding. That time is your friend. But I think if you can just buy the high quality businesses and hold on to them, you'll generally do pretty well, I think. You know, when you start out in this, you know, you try and get cute and trade about too much and try and buy something cheap and hope it doubles. But I think, you know, often the big, boring, high quality income producing businesses that are managed by good people, you know, are the ones you should own for the long term. I think the only other thing in this game as well, you've got to stay pretty humble, and persistence is important because you're going to be wrong a lot, and you just got to kind of keep learning, stay curious, and stay for the long term.
There's a lot in that one. I like it. Good answer, mate. How about you, Tom? No pressure.
Yeah, I think one of the dinners that Will mentioned before when we were in Omaha was with Peter Kaufman, and you know what he told us at the end really resonated with us, and it was don't have destination anxiety, which simply meant don't try and get there too fast. And I think from my point of view, being, you know, 5th generation family member in Souls, was probably when I started it. You know, you probably want to try and get to that sort of middle management area as soon as you could, and with the risk of not learning anything or having any experience. So I think, you know, if I'd told myself that or heard that 20, 30 years ago, then just, you know, take the foot off the gas. Things will be what it'll be, and, you know, surround yourself with good quality people, then, you know, things will work out.
Great advice, gents, from both of you. It's the first episode we've ever done with 3 of us, and I couldn't have thought of 2 better blokes to do it with. So thanks for finding time today, guys.
We appreciate the opportunity. Thanks very much for having us.
Yeah, good on you, Alan. Thanks very much.